Disney stock is popping in the after hours. We'll talk about some of the reasons why. Obviously, you had Q3 earnings come out today for Disney. We'll take a look at the revenue, the profits, everything that you need to know to get you comfortable with your Disney position. Now, we'll also look at this from a technical perspective. Look, just a couple of weeks ago, we were down here on the lows, and now, boom, we're all the way up here at $119, nearly $120 per share in the after hours. I tell you what, year to date, Disney stock down 28%, but over the last month, like a lot of stocks, this one's caught a bid, up over 19%, and it's going up even more after these Q3 numbers came in after the bell. We had revenue over at Disney coming in at $21.5 billion. That was 26% growth year over year, and that beat expectations by over $490 million. Now, it was expected to be a very good quarter over at Disney from a revenue growth perspective. Essentially, Wall Street having it grow at that 23%. Some of that has to do with the year-over-year comps over at Disneyland. This time last year, people were slightly less willing to travel. This year, pretty much all restrictions are off at Disneyland. So you'd expect solid growth there for the upcoming quarter. We're talking about the Q4, essentially Q3 from a calendar perspective here in the United States. That's Q4 for Disney. Wall Street expecting about 16% growth. And I tell you what, when we go through these financials, I don't think there's any reason to believe that Disney's not going to be able to meet the mark in Q4 and potentially for what Wall Street has projected over the next couple of quarters. Wall Street has pretty modest, kind of high single digits, maybe low double digit growth over at Disney, essentially into the future. And if some of the trends remained, wouldn't surprise me if they are able to meet some of that. Now, some of the other things that will benefit this company is they announced several price hikes for Disney Plus. You're going to go up to a $10.99 subscription on the ad-free side. That's a 38% increase on that pricing. They are also introducing an ad-supported Disney Plus model at $7.99 per month, and that comes in at December 8th. Hulu seeing price increases, ESPN Plus, they also have a bundle. Everything's essentially seeing a price increase at Disney. Now, from a valuation perspective, despite the pretty rapid increase on this share price over the past month, this stock is still trading at, historically compared to itself, a pretty reasonable valuation. Right now, trading just north of 34 times cash flows. You see, over the last 3 years, anytime this stock has gotten down here close to 30 times cash flows, it's caught a bid. You see evidence of that when you come over here and look at the chart. There's essentially an area where buyers just step in automatically down at about $90 per share at Disney. Now, I do want to get into some of the more controversial things at Disney. Now, some investors might avoid Disney altogether because they believe it is too woke. And look, that is your own personal choice. This is not the social justice channel. This is not the I want you to be woke channel. This is the investor channel. And I'm going to be 100% honest with you guys. If a company being woke means high profits, high revenue growth, high cash flows, and high returns for investors, sign me up. I really don't care. Not every investor is going to be like that. But where I start to draw the line a little bit is the line that Disney is starting to cross. Disney released a movie earlier this year called Lightyear. It had I'm not going to say the scene is controversial because it's not really controversial to me, but there was a scene in there in some countries, in some religions, is viewed as controversial. And so certain countries out there, including the United Arab Emirates, among others, decided to not show this movie. And look, if Disney was just printing cash like the Federal Reserve and it was just raining money at Disney, I would have absolutely no problem with this. The problem is what we are seeing evidence of is ESPN is facing bigger and bigger competition across the board, but now you have new players bidding for contracts. This company had a near 40-year relationship. We're talking not decades. We're talking about a generation of Big Ten football and Big Ten sports has been shown on ESPN and ABC, and that contract now ends. Disney/ESPN is now finding itself competing with Apple, the mother of all cash balances, the mother of cash flows, and also Amazon, a company that has so much leeway with investors. The stock has gone, quote, overvalued for the last 20 years as investors are playing essentially the long game with Amazon as well. Disney Disney does not have that advantage with its stock. It doesn't have it with its cash flows, and it doesn't have it from a cash balance sheet perspective. This certainly is a headwind for ESPN. It's certainly a headwind for ABC, as ESPN/Disney essentially rely on pretty hefty affiliate fees, essentially cable providers paying several dollars per user in order to just carry ESPN. If ESPN is no longer carrying customers' favorite football games, are they going to be able to still command the premium on those fees and those advertisements? That's a question that remains to be answered. I could see how ending these type of relationships and letting the big boys like Apple and Amazon just blow billions of dollars on these contracts. I could see how ESPN could sneak in there with a lot of low dollar pregame and postgame shows and just milk the cash cow that probably comes from that. But it remains to be seen how those affiliate fees will be impacted, considering your Big Ten football game, your NFL games, your NBA games, your baseball games can now be all found almost anywhere but ESPN. Now, let's jump over to these numbers. The Disney parks are on fire. $4.3 billion worth of revenue last year, all the way up to $7.4 billion. Now, we know this 70% growth year over year on Disneyland, not necessarily comparable. So what I wanted to do is I wanted to pull up a quarter ago. Let's just compare quarter over quarter because this is on fire. Last quarter, you were at $6.7 billion. So you grew that even more, up to $7.4 billion. Now, this is fantastic. I think the question we need to ask as an investors is this really how it's going to be into the future? Was there just pent-up demand from parents that were trapped at home with their little kids, and then all of a sudden, once it was okay to go to Disneyland, they planned that trip and went? Are they going to go back next year? Are we going to see this type of demand for Disneyland next year? I honestly don't know the answer to that. So that's certainly a risk with Disneyland. If these Disneyland parks revenues, if this is essentially a peak and then we come down, but if this is a new plateau where every summer we can expect between 6 and 7, maybe as high as $8 billion worth of revenue, hello, I don't care what scene you got in a movie. This is a fantastic investment because you look over the last 9 months, just over at Disneyland, you got over $21 billion worth of revenue. Let's give them credit for a fantastic quarter and just kind of round it up. You got $30 billion worth of revenue. I'm not even talking about ESPN or ABC or any of the networks. I'm talking about just strictly Disneyland. You got a business doing $30 billion in a year in revenue, and you got a $196 billion market cap on this one. On top of that, take a look at the operating profits we're churning out over at Disneyland. $7.4 billion worth of revenue, $2.2 billion worth of operating profits for the 9-month period. It holds true. You had $21 billion worth of revenue, over $6.4 billion worth of operating profits. Just that, if you just separated Disneyland into its own separate stock, its own separate company, one doing north of about 25, close to $30 billion worth of revenue, and $8 to $10 billion worth of operating profits in a year, I tell you what, in a hot market, that company alone would be worth pretty darn close to $190 billion. Now, we still have ESPN, ABC, and all the networks. That came in at $14.1 billion. That was a change of about 11% year over year. Unfortunately, with this company is that they're seeing the cost of battling Apple and Amazon and obviously the incumbents like a CBS and a Fox for these big sports rights. And we're seeing operating profits at that segment of the business continue to decline. So despite the increase in revenue, we saw our operating income decline 32% from $2 billion down to about $1.4 billion. For the 9 months, same story, down 35% on the operating profits despite 12% increases on the revenue. I know a lot of people are buying this stock essentially for that direct to consumer, the Hulu, the Disney Plus. We see last year that is the fastest growing division when we look at this $14 billion worth of revenue from the entertainment, the TV. The fastest growing division in there is that 19%, growing from 4.2 up to about $5 billion. Now, they do have a little bit faster growing segment in there, and that's the content sales and licensing. That's up 26%. But I do want to still point out, it's this linear network. This is your traditional ABC, ESPN bundled in some kind of cable bundle, or even like a YouTube TV or a Fubo. Look, that came in at $7.1 billion worth of revenue, and the operating income all came from that, nearly $2.5 billion. So despite just a 3% increase there, your operating profits increased over 13% year over year on a quarterly basis. You're losing money still on direct to consumer to the tune of over $1 billion. And how you lose money on content sales and licensing, I'm not exactly sure, but off $2.1 billion worth of sales, you lost about $27 million. So yes, we'll talk more about this direct to consumer here in a minute, and these price increases that Disney announced, this will certainly help close the gap from an operating profits perspective. But right now, still the bread and butter of the linear TV network is that traditional cable bundle. And we have to wonder if losing all of these great relationships that ESPN has cultivated over the past couple of decades, will that come back to bite them? And will this company start to look back and say, hey, yes, it might just be 10 million, 20, 30, 40 million dollars here or there when a large country decides not to show a movie. But is that really the best business decision for shareholders when these rights contracts are getting bid up by the likes of Apple and Amazon, which in the case of Apple has almost an unlimited budget? Now, over to the different streaming segments, we're seeing across the board strength in terms of the total number of members that have signed up. Somehow Disney is thinking they're going to be able to pass these price increases on. That certainly will help profit, but we'll see how that impacts churn. We saw that with Netflix. The minute they started passing on price increases, well, customers started to balk at that. We'll see if that's the case with Disney in the upcoming quarters as well. Now, from a high level, we had that $21.5 billion worth of revenue. Again, that's all in at Disney. That's the parks, that's ESPN, that's ABC, that's everything. Last year, you had about $17 billion. This is not a high margin business, okay? So it's never going to catch that big multiple. And if Disney ever has a big multiple, it's probably when I would personally sell the stock, because you look at your costs and expenses coming in about $19 billion. That gives you about $2.1 billion worth of operating profits. Last year, you're sitting about 900 and basically $1 billion. So they've done a nice job at Disney as these parks and experience, as that revenue has started to come back. A ton of that is flowing down into operating profits, and a lot of it is ending up flowing down to net income and positive cash flows for Disney. Now, from a balance sheet perspective, cash has left the building a little bit over the last 9 months or so. We see last year you had about $16 billion worth of cash. Now you got closer to 13. This company does have a fair amount of long-term debt as well. I mean, I say fair amount. It went from $48.5 billion last year to $46. I'm going to show you the cost of this as well for Disney. Notice in the most recent quarter, interest expense coming in at $360 million. I want to show you a year ago, it was $445 million. Again, this is a company that from the operating perspective printed under $1 billion, just under $1 billion worth of revenue. $445 million is half of that cost. So this debt at Disney, not insignificant, and certainly is a hefty cost if they're not able to sustain their growth and their operating profits. The cost of that debt will just chew into the margins on the bottom line for Disney. Now, for the last 9 months, pulled down a pretty stellar $3.3 billion worth of net income. That's about $1 billion. In fact, over $1 billion where we were last year. As you'd expect, a lot of that flowed through to operating cash flows. Those came in at $3.5 billion. That's about $600 million more than you were last year when you were closer to about 2.9. On the investing side, they continue to invest in those parks to the tune of $3.8 billion over the last 9 months. They did about $2.5 billion of investments last year. From the financing side, they did reduce borrowing. So when I showed you the balance sheet and the cash went down a little bit at Disney, well, most of that went to borrowings. Well, they paid back about $2.9 billion in this period last year, only about $1.4 billion this year. But if Disney is able to continue to produce results like this, they should be able to continue to reduce the cost of that debt. And they are also ultimately going to reduce their costs when they don't pay up for these large sports rights. And it just remains to be seen how popular and how must ESPN remains for sports fans if they are not showing the games themselves. Certainly pregame and postgame will remain popular, but will ESPN remain as popular when you have pre and postgame on the stations that are covering this? And you also have new offerings from Apple and Amazon, among the plethora of other choices from podcasts to YouTube and other ways fans experience the game pre and post the actual action. Now, from a technical perspective at Disney, looking spectacular. From a technical perspective, we were down here just a couple of weeks ago at that $90. That's just such a hard level. I turned this to a green line because I tell you what, Disney hits 90. Whether or not you like woke movies or not, you probably should buy the stock here because it bounces like a basketball. And now we're all the way up here towards what I would call the top end of the consolidation range at about $120, because every time Disney finds itself going over $120 per share, it finds itself back into the sideways consolidations between 92 and 120. Wouldn't necessarily be a buyer of Disney at this moment. You could have a momentum break above this 120 area. It certainly have done that in the past, more recent past as well. If you are of the belief that we are to a new set of expectations for Disneyland and that every summer from here into infinity, this company can expect 21, 22, upwards of 30, $35 billion worth of revenue from Disneyland on a 12-month basis for the upcoming years ahead. And not only do that, but print operating profits north of 7, 8, 9, even $10 billion. Well, yeah, this stock's probably going to bust up into this range. But obviously complicating that situation is the fact that this company is losing a lot of the actual sports rights and the actual games. And it remains to be seen if ESPN really is able to collect those affiliate fees when and if that situation materializes. I personally would wait for this stock to get rejected. It's highly possible it gets rejected here at 120. The momentum could carry this one into the 120s, 130s, maybe even as high as 140s. I think you meet some resistance there. If you do like this stock, anywhere south of 120 is not a bad place. But for me personally, there's too many questions over at Disney. What's going to happen with these relationships once they end and they don't actually show a lot of games on ESPN? And is this just pent-up demand at Disneyland? Or is this the new normal that we can expect year after year? I'd love to hear your thoughts down in the comments. We'll be back some other time here on the channel, but that was it for now. Have a great day and good luck with your investments.